Hello, I'm Justin Susi, Chief Investment Officer and co-founder of GNS Capital. I'm recording this on Friday, April 4th. It's a little after 10 o'clock a.m. Mountain Standard Time. I am actually up in the mountains right now, so apologies for my attire. Thought it would be nice to get away for a long weekend and did not bring a suit with me. So figured it was more important to get a message out to you all. The backdrop, though, I think is pretty appropriate. We've got flags from a number of foreign countries, and given what's going on with global trade and tariffs right now, that's causing the market quite a bit of uncertainty and concern. So I'll start by just sharing a couple of images, a couple of charts, and then some perspective on how we're dealing with the markets here. So the first one I pulled up, this is the VIX, the volatility index on the market, and really gauges the fear and the uncertainty that's within the marketplace. This is a 10-year look back, and every one of these bars is a week's worth of data. And you can see some historical points that you'll remember. Here we've got 2020, COVID, obviously a lot of fear in that market, a lot of uncertainty of what that pandemic would be and end up becoming. We've got the bear market of 2022. So that was a more gradual just drawdown of the market. And then you've got what we're going through right now, uncertainty around trade wars and what that's going to do to companies and profits and the overall economy. I will say 3 of these major events in the last 5 years is enough for me. I know it's stressful for you guys as well, but yeah, the COVID market, that was a peak to trough drop of around 34-35% in the S&P 500 before it recovered. The 2022 bear market was more in the 20s, and then so far in the current environment, we've declined maybe around 17-18%, getting close to that 20% mark. So 3 in the last 5 years, we're getting a lot of practice at this. Next, I want to push over to the S&P 500. So just a generic look at the overall market. This is the last 10 years as well. What you'll notice here, and this is more of a technical picture, but when you get to these inflection points in the market of maybe reaching a top of a trading range, highlighted by these blue bars and channels that I've got drawn on here, a lot of times that's a natural spot for the market to come back and correct and maybe retest some levels, get a little bit cheaper. So again, you can kind of see that throughout this 10-year history. And then recently, the last few months, we've been fighting with another one of those levels. So as we recorded in February, we thought we were expensive on the Mag 7. We thought the market was a little bit overpriced. Now that some of this coming down is a natural correction to that. And then I think you're seeing it become even more of a correction with the uncertainty around trade. So what you'll notice, we are down here at sort of the bottom of this other blue band right now, fighting with that, maybe fighting with the 20% down level. Market should put up a little bit of a fight here, although I think the headlines are going to probably outweigh the technicals in the short term. But at least kind of shows you what's happening in the broader markets. And then the opposite side of stocks is bonds. And if you look at a 10-year picture of bonds, unlike the bear market of 2022, that was a time frame where you actually had stocks and bonds falling at the same time. So I'll highlight that here. So again, that was a time frame where you really couldn't win on either side, even though I feel like we did a great job at navigating that bear market. This year, it's a different story. So you actually have bonds increasing in value as stocks have been declining. So that's been a nice help to the portfolios. Probably has helped most of our models outperform here in the short term. So that's a good thing. The other thing I would note is that through this 2-year time frame where we felt like bonds were a good value, we bought more bonds than any other time in the history of GNS Capital. So a lot of what's happening in the markets today, it's what did you do to prepare before the event happened and kind of watching our research, our indicators. And then there's also sort of a secondary as you're in the event and you're in the pullback, the correction, the bear market, what do you do throughout that time frame as well? I would say, we prepared pretty well with this when it comes to adding a lot of fixed income, adding some alternative investments, and lowering the risk tolerance in a lot of our clients' portfolios that were near retirement, close to retirement, or in retirement. Um, the other thing, just to talk a little bit to specific groups. So if for instance, if you're near retirement or you're in retirement, a lot of these portfolios are generating that income that you live off of on a regular basis. And I think we're doing really well in these markets with a lot less risk than what you're seeing in the headlines. If you're younger and you've not sort of achieved the savings level that you need, these are markets where you can make up a lot of ground. I'd even say to our retirement plan participants, a lot of you may not know, but we manage corporate retirement plans across the country for a number of companies. And if you're working in one of those companies and you're behind on retirement, but you've got a decent emergency fund and you've got a little bit of excess cash, this is a great time to increase those contributions by a couple of percentage points or more. And again, it won't be an instant result or instant return. I do think this volatility is going to stay around a little bit longer, similar to the COVID environment. Now, not maybe near as extreme, but it's going to take quite a while for people to understand just what these tariffs are, what they mean. But a great time to be building positions and adding money to the markets. Again, if you're younger and you've got that time horizon to build and really grow some additional wealth. Again, I think a lot of the work is done for our individual clients that, you know, ahead of time that are in those portfolios that are a little more conservative, hold a lot more bonds. We're more inclined to kind of hang on and ride that out a little bit because again, we did good work ahead of time. If we get some good counter trend rallies where the market bounces back aggressively, we might do some shifting around there. But I think the last thing you want to do is sort of panic out of the things that are paying you income. And one of the risks of doing that is you might panic into cash or money markets. Then the Fed might cut interest rates by 1%, and then the market takes off. And now all of a sudden your cash is earning less than you had before. And you kind of missed out on any sort of recovery. So, it's not a promise that we're done. I think we have more time and to get through this, there'll be more pain. But if we're looking 1, 3, 5 years down the road, we got to be careful about not reacting too aggressively to what is a lot of uncertainty. So as always, call our office, email us. I know, Greg Brown, Lou Harris, even Ryan Williams, our trader. If you want to chat with any of us, please let us know or shoot us an email and we can kind of refresh how your portfolio looks and how it's performing and behaving throughout this environment.